In 2025, gold went up a whopping 47%. That's almost twice as much as the Nasdaq and the S&P 500. These are historic numbers. But this isn't just a bull market. When gold goes up this much, it points to something much deeper. It means something is breaking in the monetary system. This is a bigger crisis that's causing the biggest gold market shakeup in a century. And what you might not realise is that it all starts with China. In this video, we're going to learn what's really behind this surge, why the gold system as we know it could be on the brink of collapse, and what you need to do about it. Let's get into it. First, let's clear up why gold is valuable in the first place. Here's a fact for you. Did you know that all the gold in the world would fit into a cube with sides 23 meters long? Gold is rare, durable, and useful. It doesn't rust or decay. It can be shaped for jewellery, electronics, and even medicine, and has been treasured by humans for thousands of years. Think about all the ways we use gold in our everyday language. That's as good as gold. The goose that lays the golden egg, he's the golden boy. Gold is firmly embedded in our consciousness. People also trust gold as a safe haven, because historically it holds its value even when money becomes inflated. So, why has the price of gold been surging? Most people think it's because central banks have been buying up massive amounts of gold. Well, they are. They're buying record amounts. This is because of the colossal amounts of money printing that's gone on since 2020 in response to the pandemic. Money printing was already high, but during the pandemic, it went into overdrive. Money printing inflates the currency and makes it less valuable because when there's more money in circulation, it makes the money everyone already had less valuable. Central banks are trying to protect their wealth by buying gold, which, as we've already mentioned, is a safer store of value during inflationary times. But that's not the only reason. When Russia invaded Ukraine in 2022, the US basically seized Russia's bank accounts. This spooked governments around the world, as they suddenly felt their money wasn't safe in the US-controlled financial system. This encouraged them to buy gold, which suddenly seemed a lot safer than US treasuries. As a result, we've seen demand for gold hit never-before-seen levels. So what's going on? It all goes back to China. China has been on a gold buying spree for over 12 consecutive months. The Chinese central bank is hoarding it. In February 2022, China divested $22.7 billion of US treasuries in order to buy gold. Divested basically means the opposite of invested, meaning they sold. They're trying to reduce their dependence on the US dollar. They've set up something called the Shanghai Gold Exchange. The aim of the Shanghai Gold Exchange is to break the grip on the paper gold market currently held by COMEX in the US and the London Bullion Market Association, or LBMA, in the UK. So, what is the paper gold market? The paper gold market refers to financial products that give investors exposure to the price of gold without requiring them to own or hold any physical metal. Instead of trading gold bars or coins, people trade contracts, shares, or certificates that represent gold. An example of this could be a gold ETF. In short, it allows investors to trade gold without dealing with the hassle of owning physical metal. This allows for massive liquidity meaning easy buying and selling. Now, here's the problem. The paper gold market is operated through a model similar to fractional reserve banking. Fractional reserve banking is basically where banks don't actually hold all the money that's deposited in them, which allows them to invest it in all sorts of places. This works fine, as long as customers don't all try to withdraw their money at the same time, which is what happened during the 2008 financial crisis and caused many banks to fail. So, the COMEX and LBMA have operated a similar way. The paper gold that investors trade isn't necessarily tied to actual physical gold. The Shanghai Gold Exchange, however, is tied to physical gold, and it turns out that people are willing to pay a premium for the safety associated with this. Here's what's been happening. Investors have been buying cheaper gold on the COMEX and LBMA, but instead of being happy with the paper gold, They've been demanding the actual physical gold. Once they get their physical gold, they sell it on for a higher price on the Shanghai Gold Exchange, which, remember, only trades in physical gold. This is called arbitrage. It's been draining the COMEX and LBMA of their physical gold reserves, and it's because of this that the price has been skyrocketing. What we're seeing is the paper gold market start to crumble. Some people estimate that there could be up to 500 paper ounces of gold for every 1 physical ounce of gold. How could this be? Let me explain. Let's say I have a gold coin. I could lend that gold coin to my friend, and he would promise to return it to me. But then he lends it to another friend, and then that friend lends it to one of his friends, and then that friend lends it to one of his friends. This means that on paper, all 5 of us can say, we have the gold coin. But in reality, only 1 gold coin exists. So, what happens if one person on the chain spends the gold coin? Then we've got a problem. This is why the Shanghai Gold Exchange has been so attractive. No one trusts that the house of cards won't come crashing down. But the problem is that the gold market's not set up to withstand everyone trying to get their physical gold at the same time. COMEX are doing everything they can to try to stop people from doing this. They require you to obtain delivery notices, get your gold from approved depositories, take out a minimum of 100 ounces, pay for storage fees, transportation and insurance costs, and the list goes on. But it's not working. London's gold stockpiles have been shrinking by the highest amount on record. So, what happens next? And what can you do about it? Well, the gold markets are trying to paper over the cracks. Recently, we saw the US lease gold from India to try to show that they have more physical gold than they actually do, and therefore bring more confidence back into the market. But history shows that this papering over the cracks strategy doesn't work. In 1944, the Bretton Agreement saw the entire world move onto a gold-backed standard. It would make the US dollar the reserve currency of the world, and the US dollar would be pegged to gold. But pegging to gold never works, because countries always print more money than they have. By 1961, the Bretton Woods Agreement was already fracturing. In an effort to paper over the cracks, a group of 8 central banks in the US and 7 of the European countries entered the London gold pool in an effort to pool their gold together and make it look like they had more gold than they did. They worked in a concerted manner to pump gold into the market at strategic moments to suppress the spikes and manipulate the gold price. It worked for 6 years, but eventually it became untenable. When the London gold pool finally ended, we saw the gold price rise from $35 to $850 in just 9 years. So, what does this mean for us? Well, firstly, I'm not a financial advisor, and this is not financial advice. But we can expect the price of gold to continue to rise. Countries around the world are currently engaging in massive stimulus, so gold will continue to be the hedge against inflation. But there's a much bigger demand for physical gold over paper gold. So, if you're currently holding paper gold, you might want to consider moving it into physical gold. Gold mining stocks should continue to perform well, again because of this demand for real physical gold. But whatever you do, make sure gold is part of a well-diversified portfolio and never invest more than you can afford to lose. You don't want all your eggs in one basket, and as we've mentioned in this video, this is the start of a new epoch in the story of gold. So we'll have to wait and see what the future holds. Thanks for watching. See you on the next one.